Welcome to Investment Guidance, where I will teach you how to make your money work for you. I'm Rudy Banerjee. Today, I will discuss the three reasons why you need to invest. Number one, compounding. Number two, inflation. Number three, saving for retirement. As you can see, compounding refers to the ability of a sum of money to grow exponentially over time by the repeated addition of earnings to the principal invested. Why is this significant? This is because it can create a snowball effect as the original investments plus the income earned from those investments grow together. In this example, the initial investment of $500 with monthly investments of $100 at an 8% rate of return will amount to $151,000 in 30 years. If you were to change this rate of growth to 15%, the ending amount would change to $554,000 a year. That is a $413,000 increase. Therefore, if you want a significant increase in wealth, you must invest wisely. Secondly, you must invest because of inflation. Inflation is the rate of increase in prices over a given period of time and results in a gradual loss of purchasing power. Purchasing power refers to how much you can buy with your money. For example, if cereal costs $1 and that it rises by 5 cents compared with a year earlier, then cereal inflation would be 5%. The most well known indicator of inflation is the Consumer Price Index, or CPI, which measures the percentage change in the prices of a basket of goods and services consumed by households. The CPI is one component that the Federal Reserve uses to direct economic policy and determine the direction of interest rates. So the next time you hear about CPI, understand that the Fed is monitoring this closely. The current CPI is 3.3%. So you must return greater than this in order to keep up with inflation. Some assets to consider that have beaten inflation consistently are stocks and cryptocurrencies, particularly Bitcoin. One thing to note, however, is that historical prices are not indicative of future results. So it is possible that we could have down years in stocks and cryptocurrencies in the future. When you think of returns, think about post tax returns. Thirdly, we must invest because you will leave the workforce someday and need money to maintain your standard of living. Some bigger expenses that you will need to pay include healthcare, bills, and going for vacations. In the United States, you will get Social Security when you reach the retirement age of 65, though it is possible that it might not exist when the younger generation gets to this age. Thank you for joining me today.